Hello, good afternoon. Welcome for another webinar from the Energy Delta Institute. Today we're going to discuss about finance and then finance in renewable energy projects. Of course, also related to COVID-19. We cannot avoid this topic, so we have to talk about it. I'm joined here today with Albert Jochems, finance expert, currently at AA Capital Invest, investing in technology mostly, from large-scale projects to smaller startups. Before that, he worked in Rabobank and Green Giraffe. So he has a lot of experience in all kinds of finance, constructions, and technology. So I hope you can enlighten us a little bit on this team. Before we start, just like last time and all the other times before this, if you have questions, you can put them in the chat box, and I will see them here on the screen, and we will try to answer them together. And for the rest, I hope you enjoy this webinar. Albert, can I give you the floor?
Yes, well, the table and some slides.
Of course.
So today I'd like to talk a bit about financing and the impact of COVID-19, as we say. And maybe first to set the scene a little bit, we discussed this already. That financing, in the context of today's discussion, I want to focus on bank financing. There are several sources of financing, equity, debt, and in this case, we're going to take a more detailed look at the debt side of the financing equation. And how is that impacted by the current crisis?
Yeah.
And first, I'd like to take a bit of a look at where are the points of impact, and maybe the most important one, and the one that we can also hear a lot about in the news, is the financial sector itself. So what happens in financial markets? And
maybe also because a lot of people, I think, sort of associate this crisis perhaps with the financial crisis 2008.
Exactly.
They have this view, at least, that it could be the same.
Well, if you hear the word crisis, and the first thing you think about is the big financial crisis in 2008, 2009, and maybe less so, but we'll get to that in some of the information of today. Maybe less so the Eurozone crisis in 2011-12. Everyone probably remembers discussions around Greece. But it actually much more evolved around Italy and Spain, where a lot was at stake with the funding of those countries. And a lot of that impacted actually the financial sector. Now, what we're seeing today is actually a whole different kind of crisis. And I would almost say it's a much more, it's much closer to home, so to say. It's everyone sort of feels and sees what's happening with all the restrictions and
more visible.
It's much more visible as it was at that time. So that's one already clear distinction we're seeing now. But if we look at...
and maybe also it's everywhere. So it's not only the European market, it is the Asian market, it is the United States, it is basically the whole world.
Yeah, but what the key thing we learned in the financial crisis of 2009 is actually that there is no difference. All these systems are connected. That was the key crisis, actually. So in any case, this works through the whole financial system.
Yeah.
Maybe we can take a look at a bit of market data. What we're showing here is actually the cost of financing of renewable energy projects. This is already monitored for, this slide goes back to 2005. It's monitored for a long time by Bloomberg. They do a great job there in collecting all this data. And the interesting part you can see in this graph is that in the period 2008-2009, we see somewhat of a steep rise in cost for renewable energy. So basically, you see a jump from around 4.5% to 7% interest rates, and it stays more or less at that level until about 2013, when it gradually comes down again. An interesting part in this slide is already that at that time there was a specific Italy premium mentioned in the graph. You can see it here as well, and you can also see it has a significant range, like almost 2%. And maybe we should bear that in mind a little. But maybe most interestingly for the discussion today, we look at the tail end of this graph, 2020, and we only have about 5 months of data available now. And what you see here is somewhat of a peak at the tail end of the graph. It's almost not visible. But you also see it coming down already pretty soon. So it's a quick peak for about a couple of weeks. And then it's slowly coming down. But maybe most importantly, it is still at historically low levels. So we're still below 4% all-in interest rates. And of course, this is a mix. So it might be different between solar projects, wind projects, biomass projects. But we're still at historically low levels.
Maybe what's interesting also, I just noticed this because I saw it before when we were discussing, but this, like the steep, the increase already started halfway 2019 mostly. Is it sort of a precursor for probably not Corona, but was something else happening, or do you think it's just a fluke a little bit?
Basically, what we saw in 2018, end of 2018, was a kind of almost what we call risk-off attitude in financial markets, where people who invest themselves in public stocks will remember December 2018, which was a big dip in many portfolios. Most of that recovered again in the course of 2019, and that's basically why you see the curve coming down. Also on the financing side. But we need to be very careful here because this is cost of debt, not cost of equity. And there is a relationship between the two. But it's not. There's no direct relationship, and maybe even more importantly, renewable energy projects. At least half of the economic equation of a renewable energy project is completely not correlated with economic developments or market developments. And that's the input factor.
It's a very interesting point.
We might come back to that a bit later.
There's one last question. I know you're here for renewable energy projects, but is this different for traditional energy projects? Because we have a lot of our audience also from the traditional side.
So some of it is not different. So another interesting part of this graph is the ECB rate. So you see a steep drop there in 2009, which basically was historic action by the ECB to lower their rates to basically counter the banking crisis in 2008, 2009. But that also led to lower long-term interest rates. And that is not only impacting renewable energy projects, because that's an important bit of impact you see here. It's impacting any financing and any project that wants to seek finance with lenders. So basically these markets work like, okay, where can I get the highest return? And if ECB rates go down, then you can put less money with the ECB because today you get negative.
You don't get anything.
Well, actually you have to pay. So that's what we basically see as of 2016. We see light blue completely disappearing. It's going below zero. So then you are forced to put your money into the market. And that goes to equity, but also it's put into funding for banks who can then lend it on to projects. So part of the graph we're seeing here is applicable also to conventional energy projects. But every sector has its own cycles and its own impact points. So maybe this is a good point to also discuss a bit of what's happening in the equity markets right now when it comes to renewables and more conventional power sources. There's one very notable bit of impact, and I wasn't able to bring a slide on that as we discussed. Is if you look at the money flow into just listed funds. And if you look into money flow, which basically means how much money goes into a certain fund compared to the average market.
Yeah.
And if that is positive, then the market prefers that kind of fund.
Yeah.
And I did a quick check this morning. I checked 3 renewable energy investment funds that are publicly listed, like some BlackRock funds, for example. They have all 3 outperformed the markets, and not by a small margin.
Okay.
Whereas if you look into the conventional energy sector, over the past weeks they have been picking up again, but they have been massively dropped by investors.
Yeah.
In other words, the financing picture we're looking at here has some resemblance between renewables and conventional. In the equities market today, we see a massive difference in a positive money flow into renewables and an outflow basically in conventional.
Is it because people perceive that as a risky or move that traditional is more risky, or is it more that they perceive a better profit margin in the renewable?
Yeah, so this is the point where I need to make this caveat. I'm just a humble electrical engineer.
Okay.
And now we move from finance to economics to social behavior.
Yeah, you're right. Yeah.
But I think most of the people watching right now can also look at their own behavior, and if anyone watching actually invests him or herself in publicly listed funds, highly likely they will have taken the same move as most other professional and amateur investors are doing. If they look at the future, a large part of the world population now believes that renewables has more future than fossil fuels.
Yeah. So,
and that's where you then put your money.
Yeah, simple as that. Yeah.
So that's the electrical engineer's view on this social.
Well, you're an investor as well, so we can dig both.
Yeah. So I can give my personal opinion, of course, and this is exactly what I've done myself.
Yeah.
I've basically withdrawn all of my investments out of classic energy and moved them into renewables and into technology.
Yeah.
So that's my nothing to do with the Energy Delta Institute. That's Albert Jochems' private strategy.
Okay.
Yes. So maybe back to the topic of today. This is basically the picture that is visible from the source from Bloomberg's data collection. There is another information point which is quite relevant for renewable energy projects, and that is, then we get even more technical.
You can handle it.
That's the phenomena of a credit default swap. Maybe a quick explanation. Credit default swap basically is someone taking over your credit risk on a certain entity. So if I want to invest into whatever, Philips, but I don't understand the risk that Philips presents, then I can ask a credit risk insurer or the financial markets in the form of a credit default swap. I can ask the financial markets basically to take over that risk. And they put a price tag on it.
Yeah.
So I swap basically my risk on Philips with them. They take over the risk and I pay them a premium in exchange for that. That's a credit default swap.
Yeah.
Those credit default swaps are also available for banks. And the graph we're showing here shows a selection of European banks where basically it is a price tag put on the risk that the market perceives for those banks.
Yeah.
An important element here is it's the 5-year credit default swap. In other words, I say to a financial investor, I don't understand the Société Générale risk. I want to invest in Société Générale and I want to do it for 5 years. Can you take over my risk?
Yeah.
And they say, okay, that's fine. But then you have to pay me 80 basis points.
Yeah.
Okay, we have a deal. That's a credit default swap. Now,
if I remember correctly, that was one of the reasons why the financial crisis also sort of started. There were too many out there, so it toppled. Let's not go into that, but it toppled after each other, right?
Let's not open that can of worms. So basically what happened was that all of a sudden the entire world discovered that also through these kind of instruments, the entire financial sector was interweaved. And if you pull out one string, then the whole...
like a domino, everything collapsed.
Everything collapsed,
Okay.
Although it's to say that credit default swaps are a slightly different animal. There.
Okay. Let's not get too technical.
Well, let's look at this nice graph. It looks like, when I come to think of it, maybe a bit like the Alpine mountains, coming from north, going to south, and then going into the Apennines into lovely Tuscany. But what we're really looking at is a graph which has remained stable until about the course of 2006. Basically, the market's not perceiving any real risks on those financial institutions. Then the first hiccup started in 2007 with the credit card and mortgage risks being perceived a lot higher. And then all of a sudden, we had the Lehman crisis in 2008, where you see a steep spike. But the real crisis is quite visible here. And that was the Euro crisis in 2011, 2012. We might all remember all the discussions around Greece. It has silenced a little bit because Greece has taken very drastic measures to improve the financial situation, that they still are suffering a lot under the debt burden, and it's questionable if they ever can recover. But financial markets actually have sort of taken that whole thing out of the equation, as you can see in this graph, because in the course of 2013,
it goes down dramatically.
It has more or less normalized, only to flame up again, and in particular in Italy with the populistic movements coming in there 2015, 16, 18 again.
So that is really attributed to that kind of political tension.
Yeah. And in particular, and that's why this graph is so interesting. You see, for example, that ING was severely also impacted by the crisis. You see credit default swaps going from, let's say, 80 to 100 basis points, all of a sudden to 300 basis points for ING as well. But then that sort of slowed down and evened out. And you can see that through the next peaks, it was mainly Santander, which is Spanish, and UniCredit. And actually, that's why it's interesting to have UniCredit in this graph.
Just to make clear,
UniCredit is Italian, and there you can basically see how it's a kind of derived Italy risk you see here. I could have put up spreads on the Italian sovereign bonds, but we're now looking at banks. And basically, I want to focus on banks because that is what is directly impacting your project, potentially. So maybe explain a little bit more what we're actually looking at here. This credit default swap basically is a measure for the cost price of your funding. So if a bank lends you money, it first needs to get the money out of the market. If they lend you money for 10 years, at least part of that lending they need to borrow or get as investments also for a longer period. So that's why I choose this 5-year CDS. 10-year is hardly available, by the way. So 5 years is the longest period where there is a solid amount of data available. This is a kind of measure of what it costs for the bank to get the money into the bank to be able to lend it on to you. Well, you can imagine that if we go back to the previous graph where the all-in cost for a project might be 3% for debt. If a bank is already paying 2.5, 3%, so we always mix up between basis points.
How much basis points is that?
250 basis points is 2.5%.
Yeah, exactly.
So if UniCredit already pays 2% in funding cost, and they have to lend it on to you for maybe 2.5 or 3%, you can imagine that they won't do it.
No, because it's the profit margin is too low.
But there's no coverage for the risk they're taking. They also need to have coverage for the risk they're taking in your project. So what the impact of these peaks is, and that is what we saw in 2011, 12, we saw a massive reduction of liquidity in the market.
Yeah.
there were quite a few banks who were simply not able to lend for 10 or 15 years anymore.
Because they simply didn't have the money.
Well, they could get the money, but it was too expensive.
Yeah, okay.
They paid, so Santander at some stage was paying 6%, 7% almost, to cover the risk.
Yeah.
So that is impact item number one that happened in the euro crisis. It was a reduction of liquidity.
Mm-hmm.
The other one is an increase in cost price. Now, an increase in cost price, while still having liquidity, you can still lend to a project and say, well, instead of 3%, I want to have 5% because my costs have been rising. So that is what we saw. We saw a gradual increase in cost in that period. Now, maybe if we go a bit fast forward to today, and then there is only limited data available. Let's
only the last couple of months you can show for sure.
Yeah. And what we see is a very steep rise, actually quite comparable to the Lehman Brothers crisis in 2008.
Mm-hmm.
But not comparable to the euro crisis, because we've seen also a very rapid sort of settling for pre-crisis levels already.
Yeah.
So in this graph, for example, you can see that ING now today is actually below where it was end of 2019.
Yeah.
So
is it also a result of whatever measures governments have been taking, like the ECB, like the Fed, to really, stabilize the system, so make sure that it does not get out of hand?
That certainly has a big impact.
Yeah.
But what is maybe more important to notice here, and like we're discussing the impact on financing your project.
Yeah.
The two previous crises we're talking about, so the Lehman Brothers crisis and the Eurozone crisis, were crises in the financial systems.
Mm-hmm.
They had a direct impact on the cost price of funding in the financial system. What we're looking at today is first and foremost, of course, a
health crisis.
A health crisis.
Yeah.
A human kind of crisis.
A human-induced crisis. Yeah.
Well, that, but also private individuals are heavily impacted.
Mm-hmm.
So instead of financial markets impacting the real economy, it is members of the real economy impacting that economy.
Yeah.
And in turn, of course, there will be impact on banks. Mm-hmm. We've seen a massive increase in provisions being taken in the Q1 and Q2, not Q2, we're not finished yet, but Q1 numbers.
Yeah.
Provisions there taken by banks have risen massively.
Yeah.
European Bank has basically instructed all banks in the Eurozone to not distribute any dividends, to keep the capital buffers intact, to be able to weather the inevitable economic crisis that is basically happening now.
Yeah. But not, like you said before, actually liquidity here is not a problem.
Liquidity,
there is enough money.
there is abundance of liquidity, and that, I believe, is the key reason why any crisis very soon now sort of settles down to pre-crisis levels. Although, and then I get back to the example I just gave on the equity markets, there is a kind of readjustment on where that liquidity is flowing most heavily.
Yeah. Almost like a catalyst, you would say. It's this event, this the pandemic, as a catalyst for this redistribution of equity to renewables in this case. But something that we always aimed for as an energy transition perspective, but now it just happens quicker.
Yeah, although I also believe that you need projects to be able to put funding into.
That is true. Yeah,
and projects are, I would say, complex animals. It takes a lot of time to develop.
Yeah.
And a trigger like more liquidity will only on the long term boost the number of these projects.
Yeah.
You can't just create a project out of nothing and make use of that liquidity.
That's true.
That is, but in the longer term, there will certainly be an impact. Although we are already seeing historically low lending costs for renewable energy projects for quite a few years now.
Mm-hmm.
That is a kind of constant factor.
Yeah.
And what we also need to bear in mind is that these peaks we're seeing here are often a factor 2 or maybe even 3 of the regular funding costs. So where, let's say, maybe 15 years ago, an all-in interest rate of 6-7% was perfectly normal. We're now getting used to 2-3%.
Yeah. Okay. Yeah.
And then an increase of 1 or 2% is almost a doubling.
Yeah. So it looks massive, but
and the impact on
it is
cost is actually massive. We'll look into that in a bit more detail.
Mm-hmm.
But that is something we need to bear in mind, and maybe to sort of zoom out a little. One of the massive pieces of good news in renewable energy has been cost price reduction.
Yeah.
And how real this all is, right? We have in the Netherlands, we have these auctions for offshore projects, and the last 2 have been awarded without any subsidy.
Mm-hmm.
How profitable will these projects actually be?
Yeah.
And we've seen a lot of pressure being built up on the supply chain side. Like we cannot deliver these low costs yet.
Mm-hmm.
It's too early, or it's just barely possible. So if any risk emerges, then returns
goes
are
over
gone.
your exactly. Yeah.
But still, the general message has been cost decrease.
Yeah.
And it's not looking as if this is going to end soon.
No.
This line is the trend is still down.
Okay. Interesting.
But this is greatly helped by these relatively low cost of capital. I'll go back one slide. We're still seeing since 2005 historically, and even if you go back further, but then there's not too much relevant renewables data available.
Mm-hmm.
But basically, we're looking at a 15-year period. We're still looking at historically low funding costs.
Yeah.
They help to reduce the cost of energy as well.
Yeah. But in that sense, they help the other projects as well, right? It's overall low interest rates.
Absolutely.
Yeah.
Absolutely.
But the interesting thing, what you said also, is basically looking, of course, the disclaimer is we don't know the future, so it can still get out of hand. But what we're looking at here at the end of the graph is that you already see that the impact is already dissipating somewhat.
Yeah.
It is not, the crisis is not as bad in the financial sector as it may seem in the real world.
I think there's one key item that might actually impact that situation. And that is, of course, the whole discussion on the Eurozone crisis funding. I won't use the word Eurobond. Oh, I did it, but not using it again. But this crisis funding, it's now again evolving around this whole situation of are we going to keep Italy in the euro?
Yeah.
That discussion, if it isn't properly managed, can of course again spike a Eurozone crisis like we've seen in 2011, 2012.
Yeah, exploding the cost of financing again. Yeah.
But then
putting a brake on all these projects.
Yeah. Then Corona is not the cause, but it will be a catalyst.
Yeah. Okay.
So maybe if we have a bit time left, it's maybe good also to look more specifically at projects. And I brought this slide where I often use the middle part of this slide in many presentations because it gives a good view on all the parties, whether in contractual form or in different form, are interacting with the project and where the potential impact points are. So I've just mentioned a few in this slide. There's the there's the obvious impact point on the equity side, where basically liquidity, which we discussed, and risk appetite. We didn't discuss that so much.
But it has a link to each other, of course.
It has a link, but it also behaves independently. Like liquidity is a sort of continuous line, where risk appetite often is risk on or risk off.
Yeah.
And in a risk off situation, it might be extremely difficult to find equity for your project.
Okay.
Because then, basically, we've seen a risk-off situation with the start of the COVID-19 crisis. Basically, all investors said, "Okay, let's stop for a minute. Let's we're going to sit on our hands. We're not going to invest €1 in any company, in any project. Everything is on hold. We need to investigate what's happening here and how it's going to impact us." Mm-hmm. That is a massive risk off. And basically liquidities in all markets, whether it's debt or equity, have dropped massively in a couple of weeks' time. Yeah. But in renewables, we've seen this picking up pretty quickly again. Only after a few weeks, okay, we're in the middle of this deal structuring, let's keep on structuring. And actually over the past few weeks, we've seen press releases of projects closing their financings and their M&A transactions as if nothing is... happening.
Yeah, I think it's a good point. We had several other speakers also, touching on that, in a sense that, for example, energy transition and all the measures that people are taking, governments are taking within the energy transition is something for 50 years. It's not, or 30 years. It is not. Of course, we have a serious crisis now and perhaps a bit of a hiccup in that sense, but it is not stopping that trend in general. So it would be logical that at least part of those deals will continue as well. If you're already in the middle of a deal, I would say.
Well, there's one very important element into this, why this is happening. Mm-hmm. And it is basically, on this slide, wind is one of the inputs in a project. And I say no impact.
Yeah, that's one of the questions actually, unpredictable weather. But you say in a project, it is not unpredictable.
Well, weather is highly unpredictable. It's highly predictable for today. Mm-hmm. Even tomorrow, and probably the next 36 hours is highly predictable. Yeah. Next week, difficult. Next month, virtually impossible. Yeah. But the next 12 months, highly predictable. Mm-hmm. The next 10 years, extremely predictable. Yeah. With wind speeds, if you take just any year in a 10-year period, it might deviate massively. Yeah. But if you take any block of 10 years, in the past 30 years, it will be almost the same in terms of average wind speed. There is a little bit of climate impact there, but that is like 1 or 2% in the overall equation. So wind is an extremely reliable statistical phenomena.
Solar as well, probably.
Exactly, solar as well. Yeah. I would say in renewable energy, probably tidal energy has the highest predictability of all sources, because we can today even predict what the tidal movement in 120 years' time on Monday, the 13th of June, will be at 12 o'clock in the afternoon. Yeah. We can predict that now. So that's just...
It's really, really reliable.
Brilliant, yeah. But more importantly, to get back to this slide, wind isn't distracted by economic developments. Mm-hmm. It's not even distracted by pandemics. It's not distracted by OPEC cartels deciding whether or not to increase production. Yeah. It's a completely independent statistical phenomena. Mm-hmm. And that is what makes it highly attractive to investors who want to find investments that sort of try to distance themselves a bit from what's happening in the rest of the economy. Mm-hmm. Now, we need to be aware this is only half of the equation. It's the input in the project. Yeah. The output of the project, the power, of course, is
price
always...
fluctuation. Yeah.
Exactly.
But then, of course, what you mentioned this example before is that this is similar to another power plant, but then the input is also unpredictable. Yeah. And then that's why this is actually more stable.
Exactly. So gas prices are, of course, you can do some long-term contracts, but it's actually becoming increasingly difficult because of the volatility in markets.
Yeah.
With wind, you don't need to do a contract. You just need to be there when it's there, and it will be there.
Yeah.
On average, it will be very predictably there for the next 10 years.
Yeah.
Then power prices are a complicated one because that is, of course, strongly related to the market. And then you will see that the other element that I've put a big red circle around, because that's the key topic of today, it's the financing of so what is provided by lenders, the debt financing. You will see that project financing will always require you to have some base level of contracted revenues. And historically, actually, it should be 100%. And that's where we are a bit on a pivot point right now in renewable energy markets, because we're moving away from fixed price, long-term schemes subsidized to market-driven,
volatile pricings.
So there you'll see that if you want to raise any debt financing for your project, you will need to have at least some level of contracted power offtake. So a power purchase agreement, maybe with a corporate entity or with a utility.
Yeah, exactly, with a large off-taker, so to say. Yeah.
And in the 80s and 90s of last century, man, I'm getting old. This was the de facto structure for a power plant.
Yeah.
You had a 15-year power purchase agreement with a big utility.
Yeah. But now.
And then it appeared that big utilities could also fail.
Yeah.
Like happened massively in late 90s,
Enron.
Early 2000. Well, Enron, but also large like TXU or AES, they all failed on their European power purchase contracts. So all these power plants went into difficult phases. So we've gotten away from that a little bit. Now we are leaving the era of long-term feed-in tariffs and subsidized rates, and rebalancing a bit with, corporate PPAs is the big thing these days, and it makes sense.
Yeah, why not?
There could be corporates highly interested in fixing their cost base on the electricity side, and at the same time tapping into renewable energy in order to also meet their own goals in terms of sustainability and switching as part of the energy transition. So it makes a lot of sense. But banks will require that. Yeah. They will not be willing to...
The risk is otherwise too high.
Yeah. Merchant risk, as it's called, is very difficult to finance. Okay. It's not impossible, but you always need to have some mitigants in place. I think we need to continue a bit.
It's a good one. We do everything in between, so we can just continue.
Yeah. So I also wanted to have a bit further look at what part does this financing cost actually play in the whole cost structure of a renewable energy project. And basically the two most important parts are taken up by CAPEX and OPEX and equity returns on those CAPEX. Of course, there's the inevitable tax part, which plays a role.
Always.
That's what we also now finance a lot of the, I would say, social damping mechanisms with in the current crisis. I mean, if we hadn't been paying tax all those years, then we wouldn't have the money to do that. But what I'm showing here is basically a kind of typical North Sea offshore wind project, debt financed. 70-30 might even be regarded as a bit conservative over the past 2 years. 20 years economic life. These days we're more talking about 25 years economic lives of wind farms. And I've just taken a very simple LCOE approach, which to any of your economists watching this is an electrical engineer approaching life cycle cost.
It's about the example.
So don't look at the absolute amounts. Basically, what I've done here is to define a project and assume that the only thing that we're going to change is the cost of debt funding.
Yeah.
And then look at what should be the overall price of the power you sell over its entire life to basically get the same equity return.
Mm-hmm.
That's the kind of analysis I do here. And this, I'm just doing this to show you, to give you a better feel of what this impact of funding cost is on your electricity cost price. So if we start off with this 60 euro per megawatt hour starting point, which, let's not go into the absolute amounts discussion there.
No, but it's just a 0 point. Huh? Yeah.
We've seen in the previous slide that funding cost of banks during the euro crisis easily could take swings of 200, 300 basis points. Now, if you look at that, you can easily see that can have only that funding cost element could have an impact of more than 20% of the cost price of the power you're selling, because you end up, instead of 60, you end up at 72. So
go so high. Yeah.
Exactly. So, of course, this. Please note that the graph starts at 55 euros. It's not zero euros. So it's magnified a little bit. But you need to bear this in mind when you're developing your project, and you need to bear this in mind when you are going to approach a bank.
Is it also timing, as in, a project is like 20 years. So if you start with this project development and you go to the bank, you want to get your debt financing. Is it then, does the bank only look at what it costs the bank today to take the money out of the market, or does it also look at the risk of, for example, that it will go down? Because that's often volatility in that part.
That's the whole complexity of financing a renewable energy project. Remember, renewable energy project is capex intensive. Mm-hmm. So you have a massive investment during construction, and then after that you have very low cost levels throughout. Yeah. But you need to finance this initial massive investment in the first year, and you can only repay it over a period of 15 years. So yes, when you go to a bank and ask the bank for money, they need to take a view on how is this project going to behave for the next 15 years. But also, and that goes back to this CDS, this credit default swap example I showed you, investors in that bank will also say, well, if you're going to lend a project for 15 years, you at least need to have a certain part of your funding also secured for that 15 years.
Yeah, exactly, yeah.
Which means we are going to take a risk view on you, bank, for a long period.
Yeah.
So it's
but that can indeed, that can vary massively without you really knowing it, because nobody could predict the pandemic, for example. Well, maybe people could predict a financial crisis, but things like that, of course, happen. But then it does not have an impact on your project already started, right? It is only
So if you have
now.
If you go to the bank today and you say, I've developed this very nice project and I want to start construction next month, please give me the money. Yeah. Then they will look at it and say, okay, world has changed a little. Yeah. We're in a bit of a crisis right now. How is this going to impact you? And they will look at the treasury and say, how is it impacting us?
Yeah, exactly. Go the other way. Yeah.
Because we need to get our funding as well.
Yeah.
So a project which is already operational and has its funding in place will see very little impact of little to no impact
of the
financial elements that we just shown in this presentation.
Because you fixed it, so to say. Yeah.
Yes.
Okay.
You got your funding already.
Yeah, but if you start now, then you basically have to deal with this uncertainty part. At least have a good answer for that.
What the banks will say, because if you go to banks for financing, they will also want to have a say in your project. And they will say, I want to see your plan now. What is going to happen if your service vessel, which is out there with 40 people crew, servicing your wind turbines, keep them running, if you have an infection on board? Yeah. If someone is diagnosed with COVID-19? Yeah. Does the whole crew have to go in quarantine? Do you have to swap the whole crew? How long are you going to be out of operation? Yeah. You will need to have
But do you need additional capital yourself, basically, to cover that risk?
Maybe working capital.
Yeah, working capital, yeah.
But that, in a typical renewable energy project, is just marginal compared to the initial capex investment.
Yeah, true. Okay.
Unless you're in construction phase, where it becomes very sensitive. Because a typical installation vessel might cost a couple of $100,000 per day to keep it operational.
Yeah.
And if that vessel has to go back to shore, change the entire crew, sanitize everything, and go back and is out of business for 2 weeks, that's a massive cost increase.
Yeah.
With all the knock-on effects on everything that has to follow after that in construction.
So basically now it is a little risky to start your project. You would perhaps be better, I'm speculating here, you would have be better off to wait a couple of months until the...
I don't think so, because you might need to do a bit better contingency planning.
Yeah, okay. Yeah.
That is basically the key here.
Yeah.
But you need to do good contingency planning anyway if you're going to raise debt financing.
Yeah, that's true.
So one of the other questions was about if you could actually foresee what kind of risk management could have foreseen this, right?
Yeah.
Well,
none.
But that is also, and that's in any financing documentation, there's always this famous force majeure clause.
Yeah.
And I had to think about it a couple of times over the past months. And I'm currently involved in restructuring a contract where that also plays a role. I've never actually taken this clause very seriously.
No.
Yeah, that's something for the lawyers. Yeah. Really. That's.
Yeah, but it's the same.
But literally in all of the clauses that I've been involved in the last maybe 20 years, pandemic is part of that force majeure clause.
Yeah. So depending on which side of the table you're sitting, you're happy that it's there.
Why are the clouds around us all of a sudden getting darker?
I don't know. Maybe that's it. I don't think.
We're discussing force majeure.
Yeah, but it is interesting. You know, it is there. It's a thing that's already been built in these contracts, but now it suddenly becomes reality. Yeah. And you can do something with it, depending on if you're on that side of the table or on the side of the project.
But the fact that it is placed in the force majeure clause and not in any of the other clauses of a contract which regulate the interaction between a bank and a project already says that this is like, well, often the term higher power is being used. Yeah. You cannot foresee the exact thing and the consequences of that exact thing with any kind of risk management.
No.
You can structure it in a contract by taking this whole force majeure clause serious, which a lot more people will start to do now.
Yeah.
And say, okay, well, what if that happens? How are we going to interact with each other? How are we going to take those measures that will make sure that both sides of the contractual equation survive? Yeah. Or if it's not possible to have them survive, that we have it built down in a controlled manner.
Yeah.
So that we're not ending up in
fighting.
Exactly.
Yeah. Yeah, because on the other hand, do you think it has an impact on, for example, a premium or something on top of insurance or other financing systems? Because this force majeure, they take it seriously now. Do you think that will happen or not?
Well, force majeure basically is one of those mechanisms. And again, now we're moving into the legal territory, and I'm just an electrical engineer. Force majeure is one of those legal territories where you basically kind of agree, we can't agree on anything specific here.
It just happens.
It might happen.
Yeah.
And if it happens, we're going to behave like this.
Yeah.
You cannot put a price tag on it.
No.
The only thing you can agree on is we're going to interact in a certain way to try and find a solution.
Yeah, because I was thinking about a very, that has nothing to do with energy, but for example, festivals and things like that, apparently they cannot get any insurance for next year because of that force majeure clause. So in that sense, I was wondering if that also applies to this kind of projects, but perhaps that's different.
But this is a very typical risk-off moment for that particular type of risk.
Yeah.
People say, well,
I'm not going to do it.
I don't understand this risk anymore, so I'm not willing to step into it.
Yeah.
Mind you, over the past decades, they've been stepping into it without understanding it actually, because no one looked at it.
That's true. Yeah.
So,
it comes back to bite you a little bit.
And then maybe we don't have a lot of time left, but I also.
Well, you can put on your last slide also where it says what you have to do. Yeah?
I promised to also say a bit on how to mitigate, and actually, it's a very simple answer. Basically, you have to do what you always have to do when you want to raise debt financing, and it's. Three things are important. Number one, prepare. Number two, prepare. And number three, prepare.
Yeah.
And we might be laughing about this, but it's actually quite crazy to see how many people believe that they can go with a plan, an idea, a thought, put it in a couple of PowerPoint slides, go to a bank, give me the money.
Yeah.
It simply doesn't work.
And then
like
they
that.
get slaughtered on the table, at the table. Yeah.
In particular, in project finance, it's all about the details. It is about your own analysis you make, and it's all about preempting any conceivable question that a bank may ask you, and being able to answer it.
Yeah.
And as an entrepreneur, you always want to look at the upside. As a developer, you always want to look at what upside is there. A bank is not interested in upside.
No.
They're totally not interested in upside. That's your upside. They won't benefit from any of that.
No.
They're only interested in protection against downside. And not only protection, but also understanding downside. And that's where this whole preparation thing comes in.
Yeah, so you can explain the risk, so to say, to the bank, to their satisfaction.
They ask you a question, say, we've looked at that. This is the financial impact of that particular scenario.
Yeah.
Next question.
Yeah.
We've looked at that.
Yeah.
This is the impact of that particular scenario.
Yeah.
And that analysis is actually key. And basically, in my own past ventures, as an advisory work and also as working at a bank has always been the key to making things possible where it was difficult for other parties to do.
Yeah. Yeah, because you sort of anticipated this better. You got more into details that are significant for the bank.
Preempt.
Yeah, preempt.
Preempt all those questions.
Yeah.
And then it requires a thorough and detailed approach, and it requires some solid financial modeling.
Yeah.
And in particular, and that is to go back to that example of that installation vessel that someone has contracted COVID-19 on board. It's a typical delay scenario.
Yeah.
And delay scenarios are notoriously difficult to put into financial models in any accurate way. And that's you need quite robust financial models to be able to model that.
Yeah.
But these delay scenarios are usually the key things that actually happen all the time.
Yeah.
And whether it's COVID-19 or whether it's some lifting equipment failing.
Or a hurricane.
Or but then we get to the weather risk again.
Okay, but whatever it is, there's always something. Yeah.
Equipment being delayed in supply, and that is, that's basically the key message: how to mitigate, prepare, analyze.
Yeah, prepare. Yeah. I think that's a very good one to sort of end the session also with you with this. What I liked about this is actually, I know it's very technical, but the thing is that the view of the financial part of a project or renewable project can be quite different from the technical view or the view that is, okay, this is great, we're going to put it in and that's fine. But on the other hand, you see also your slides show that for this COVID-19 crisis, in financial terms, it is not that big of a crisis in the sense of the lending power, the debt part. And I think that's interesting to take away, except of course that we don't know yet how it will evolve. Yeah. So there are still risks there. But if you then prepare for your project in a good way anyway, you can still continue with that.
Even through this Eurozone crisis, we've closed projects with billion euro financings.
Yeah. As long as it's a solid project, it will just continue.
Exactly.
Yeah. And the interesting thing, of course, the capital fleeing a little bit, equity from the traditional part to the more renewable part. Whether or not it is deserved, maybe we don't know yet, but it is.
It's happening.
It's happening, yeah.
And in a massive way, billions of euros flowing from one to the other.
Yeah, the link, maybe that's a final question. The link to these funds that are being available from governments, from the EU and things like that, they have a massive green part in it. So that reflects actually that trend, or not? Is it sort of? Do they link to each other? Maybe that's
somewhat, but I've always seen that it's very difficult for that money to actually flow into projects.
Mm-hmm.
So, for example, European Investment Bank has been co-financing quite a few, for example, offshore wind farms also over the past years. But they almost never have played a pivotal role in that project happening. There was always the need for commercial lenders also to come in. It did enhance liquidity, but there's no shortage of liquidity right now. So, that kind of money is much more valuable if it's able to take more risk.
Yeah, exactly.
And go into newer technologies or into technology development or into demonstration projects to keep on fueling this whole technology development part.
Yeah, I don't know if it is aimed at that, to be honest. Maybe somewhat. Like hydrogen, for example, I think is an example project where people are talking about. It's also part of this green initiatives, and that's something that is not there yet.
Yeah, but but hydrogen is much more of a future development, whereas offshore wind is a kind of established development today.
But there, as you said, the money is in that sense available. If you have a robust project, you can just go ahead. You don't need this green recovery fund to do that.
The only thing that might be considered again is to go back to. But now I'm just like this. A lot of people will say, "Are you completely out of your mind?" To go back to some kind of feed-in tariff situation, or at least some kind of stability in the offtake side. Which could also be by promoting switch to electrical power in industries. That's another way of doing it.
Yeah, that's true. So then you support that side, and then the project will come because
the electricity is needed.
Yeah, exactly. Okay, very interesting. Thank you very much. I think we'll stop for today. And I had a very nice session with you, Jochem. So thank you again. And indeed, we have another webinar coming up on an online course on financing the energy transition. Next week, there will also be a webinar with Hydrogen Europe on hydrogen, and this time hydrogen in the energy transition or the energy system in general. So there's still enough to discuss. Thank you again. And to all the audience, have a great day. And hopefully we'll see you next time in our hydrogen webinar.